Investing 101, how to avoid psychological investing errors. Joining us for that is Jim Uren of Phase 3 Advisory Services. I'm so excited about this topic, Jim, because investing with the wrong mindset never ends well. What are some of the errors that you see?
Certainly, yes. So some of the areas we see, well, the first one that comes to mind is something we call recency bias. And that's where we as humans tend to overweight more recent information in comparison to past information. And in a lot of areas of life, that works out just fine, but investing, that can cause problems. So for example, if given the choice between, let's say, a high long-term rate of return on an investment, but one that has recently not done so well, versus the opposite, investment that's done very well over long-term, but not so well recently, most investors choose the one that's done well recently, even though the research would suggest you're better off choosing the investment that's performed well over long periods of time. We tend to have what we call that recency bias, and we overweight the evidence, and so it ends up costing us money when we invest.
Also, people get overconfident.
Yes, this is, of course, true of many of us, but we see this when it actually matters in investing, and we see that people who are overconfident, which generally tends to be most of us, but particularly some of the research suggests, for example, that men tend to be overconfident. One recent study looked at men versus women, and the men scored much more overconfident, which led them to trade a lot more stocks a lot more often. This, of course, led to higher cost. And at the end of the day, guess what? The guys performed much worse than the ladies because of this overconfidence. So this overconfidence can cost you real dollars in investing.
Which brings us to loss aversion bias. People are afraid of losing money.
We are. And the research on this goes back a ways. There's Nobel Prize winning research by a guy named Daniel Kahneman. And what they've been able to show is that when we lose money, it's twice as painful as an equivalent gain. So in other words, if we lose $50, we've got to gain $100 just to kind of emotionally break even. And unfortunately, that leads us way into how we trade stocks. And so the research is pretty clear. What we tend to do is when we buy stocks, we tend to sell our winning stocks too early. Why? Because we want to lock in that gain and show the win. And we tend to hang on to our losing stocks way too long because we don't want to basically admit that we might have made a mistake and lock in that loss. And so what tends to happen, of course, is that affects our rate of return because of that aversion to loss.
And then people often go for investing in what's familiar. Why is that a problem?
Yeah, so there's a strong familiarity bias in that we tend to be drawn and invest in things to which we are familiar. Not necessarily those which we understand more, but for which is familiar. So, for example, viewers in Detroit are probably more likely to purchase automobile stocks, and viewers in San Francisco may be more likely to purchase tech stocks because, of course, that's what gets the most press in those particular areas. Unfortunately, what that can do is that can lead to, one, missed opportunities because we might miss out on some things that otherwise would have been a good investment. But two, it can also lead to reduced diversification, which of course can provide some protection for us, particularly in choppy markets. So that familiarity bias can also hit our pocketbook quite a bit when it comes to investing.
That was just terrific. Thank you, Jim.
Thanks for having me. It's good to see you.
Go to businessfirstam.com for where to see our show on TV.